Are you tired of taking what seems to be an endless amount of losing trades? What if I told you there was a simple day trading strategy that anyone from beginners or experts can adapt to, and it will help you remain profitable for years to come? It involves using the volume profile, which is a tool used to analyze and visualize the volume, or the numbers of traded contracts or shares, at different price levels within a specified time period. Imagine a vertical histogram on the side of your price chart showing bars that represent the amount of trading activity at various price levels. See the red lines on the S&P 500? Those are what's called the value area low, which represents the lower boundary of the price range where a specified percentage of today's total trading volume occurred. See the green lines on the chart? That's called the value area high, and this is the opposite side of the range. So, you can start to see where this would work really well on range days that are nice and steady. There's no news catalyst to worry about or any other major news events. So what is this strategy? Buying on the value area low. When the price of an asset drops to the lower end of the value area, consider it a potential buying opportunity. This strategy assumes that when the price is near the lower value area, it may have reached a point where the buyers find it attractive enough, and there's a good chance that the price may bounce back up. Selling on the value area high. Conversely, when the price reaches the upper end of the value area, it could be seen as a potential selling opportunity. The idea here is that when the price is near the upper value area, it might be considered overvalued, and that could be a chance for a downward movement. Why does this strategy work? When you think of where the most opportunity sits in terms of volume, it would be in the middle of a range. Playing the extremes is a great way to get a really good price on a stock towards the upside or the downside. One important thing to talk about is this white line here, otherwise known as the point of control or POC. The point of control is like a central hub within the value area representing the price at which most buying and selling activity took place. Traders often pay attention to the POC as it can act as a significant reference point. If price moves away from the POC, it might indicate a shift in market sentiment, and traders may use it as a guide for potential price movements. So you could easily take a long opportunity from the value area low all the way to the POC as a solid entry. The same could be said for taking a short opportunity from the value area high all the way to the POC. One extremely important thing you'll need to be aware of is always make sure you have proper risk management in place. Never, and I mean never, enter a trade without a stop loss. A stop loss is like a safety net for your trades. It's a predetermined price level at which you've decided to automatically sell to limit your potential losses. Think of it as a protective measure that helps you control risks by closing the trade if the market moves against you, preventing bigger losses than you're comfortable with. It can also be scary if you start to see the POC or the value areas shift throughout the trading day. In the case of the POC, this means that most of the buying and selling is in the place where you've entered your position at. I tend to exit the position if this happens and move on to another trade. The same thing can happen if you're trading in the value area high and boom, the price keeps moving up with it. Under these circumstances, it's best to accept the risk and move on to the next setup. So, how do you trade this strategy? Step 1. You want to use this indicator on TradingView. It gives you the entire value area high, low, as well as the point of control in a single indicator. It's fine to leave the default settings here. Step 2. You'll want to add it again, and instead of having this 70% marker, we're going to change it to 95, and we're going to make it a solid line. This gives you only the most extreme circumstances in terms of price action. Step 3 is the hardest thing for most traders, waiting. And if you're not patient enough to do this, be prepared to lose. Trading demands patience, waiting for the right opportunities and sticking to a well-thought-out plan. Rushing leads to hasty decisions and missed chances. Patience in trading involves calmly enduring market fluctuations and waiting for profitable outcomes. So when you're ready to execute, it's a good idea to take the trade either to the point of control or key levels on your chart. For a stop loss, always look for a market structure shift. A market structure shift in trading refers to a noticeable change in the pattern of price movements in the financial market. It often signifies a transition from one type of market condition to another, such as a shift from a trending market to a ranging market or vice versa.